I've seen in the recent past, the quality of earnings have definitely, taken a downturn. So for example, if you look at the earnings, the book profit or the P&L earnings, they have definitely gone up. They have gone up probably high single digits in the last 1 year. I mean, looking at September and, trailing 12 months to September and trailing 12 months of 2021. But if you look at the cash flow from operations, they have gone down by 19%. That's a sharp downtick. And hence the enterprise value to cash flow from operation ratio, which was at 16 times or 17 times last year when I had presented this, has jumped to almost 22 times. So which is pretty high for the market in a historical context, because the highest it has ever reached is about 24 times. So 24 times in 2008, 24 times in 2011, 2017, right? So it's pretty close, right? So one needs to be careful. It's not that across the board cash flows have deteriorated, or the balance sheet is pretty decent even now for corporate India. So there's not much to worry. But in terms of valuation, I think we are a little bit stretched, especially in terms of cash flow valuation. And then when you have this global context of markets having corrected significantly, Nasdaq down 33%, S&P down more than 20%, in various other markets, then the difference is pretty stark, and other markets can become much more attractive, right? So whenever the interest rates are rising, there is less room for error in terms of valuation, because the interest rates are big drag. They are huge gravitational pull on the valuation. So I think I would say, one needs to be careful and evaluate your companies in terms of cash flow, and not just look at the order books and then just the P&L earnings.
So what's the metric that you use, Samit? Part one, and therefore, does that make you cautious currently? Does that make you want to sit on a bit of cash to maybe take a tactical call, or not really?
Yeah, I mean, it makes sense. See, the metric that I generally use, and which has been a pretty good sort of predictor of market valuation, is enterprise value to cash flow from operation ratio. Because free cash flow doesn't really make sense, because if you are going for pretty aggressive investment cycle, free cash flows can be extremely volatile. But cash flow from operation is much more stable ratio, and it at least tells you more about the quality of earnings. Whether it's just the profits that we are generating, or are the profits stuck in receivables or working capital, right? So it does give you a much better perspective. So that's the metric that I use: enterprise value divided by the cash flow from operation. Tactically, I would say wherever you feel that the valuations probably have are looking stretched, better to reduce your allocation. It may make sense, because I mean there are a lot of variables for, especially in the next 2 or 3 months, right? One is we would at least know, in the next couple of months, how far would Federal Reserve go in terms of interest rates. So that's big variable, which will determine how the global markets do. And secondly, I mean, we do have the budget coming in, and you never know. I mean, this is the last full budget before the election, and what kind of decisions or policy changes that the government does can have impact on the short run. I mean, it doesn't really impact my long term sort of view on the market. I still remain extremely positive on the India story, but in the short run, I think the next 2 or 3 months can be really, really tricky.